We now start with net present value, which is undoubtedly a very important concept in finance. So net present value is the present value of an investment, project, or purchase after having accounted for all costs. So look at the letters NPV. So N is for net and then PV, present value. So essentially the idea is that you want to know if whatever you're purchasing or a project that you're investing in is a good thing to do. So what is the reasonable thing to ask? The reasonable thing to ask is how much does the project produce compared to what it consumes? So you want to compare the profits which the project produces, let's say the net cash flows which the profit produces, and see if that is greater than the costs of the project. So the complication is that these cash flows can occur in different points in time. So some of the project cash flows would be in the future, whereas the investments could be today or at some other points in time. So because of time value of money, you can't simply add up all profits produced or all cash flows per point in time and then you compare the cash produced to the costs. So that's why you have present value. So in NPV, you bring everything to the present. You look at the present value of all cash flows, and then you look at the net. So after bringing everything to the present, if you find that the amount produced exceeds the amount consumed, or the cash flows, the revenues are greater than the costs, then you will say it's a good thing to do, it's a good project, and that would correspond with the NPV being greater than 0. If the NPV is less than 0, it means that whatever it produces is less than whatever it consumes, or revenues at the brought back to the present are less than all costs, also the present value of all costs. So if that is so, you don't want to do that project because you don't want to do something which consumes more than it produces, and that would correspond to a case of NPV less than 0. So it's not a very complicated idea, it's just that you want to compare revenues to costs, and you want to do the project if revenues exceed costs, but you also have to bring everything to the present. Because of time value of money, you can't compare revenues and costs if they happen in different points in time. Here we have a simple example of NPV. We have a franchise, and the initial outlay is $1,100. So it's a negative cash flow because that's what the project consumes. The required rate of return is 10%. You need the rate of return to move money around time. And the revenues and expenses are given in this table. So you have year 1, 2, and 3. And after that, suppose the franchise disappears. It doesn't produce any more cash flows. Like I said, it's a very simple example. So what is the NPV going to be? Well, the NPV is going to be the sum of all revenues and costs, and you put a negative for the costs, so, or you can say the sum of all revenues minus the sum of all costs at the present time. So the discounted value of all revenues minus the discounted value of all costs, and that we start with the first cash flow, which is the initial outlay, and that's $1,100. And that you don't have discount because it's already at the present. So you'll have minus 1100 plus, you look at the revenue. Now net revenue for the first year, or you can say that net profit for the first year. Let's just look at profits now. So we just, every year we look at, we do the addition and subtraction of revenues and expenditures for net every year, and then we bring it back. So the net profit for the first year is 0. So it'll be 0 divided by 1.10. That's 1 plus R. Plus the second year actually produces a net profit of 500, and you want to bring it back to the present. You know, I could bring back the 2000 and the 1500 separately, but I'd be dividing them by the same factor, 1.1. So I can just do the subtraction right here at the second year and just bring back the 500. So that'll be 500 divided by 1 plus 10 squared plus 1500 divided by 1.10 cube. And you add these up, and this has a negative sign in front of it, you get $440.16. So the project has a positive NPV, which means that it should be done. Not doing this project means that you're throwing away $440.16. Okay. So what we did is we just looked at the initial outlay of minus 1100, and then we brought back the profit from the next 3 years back to the present, and then the sum was 440 positive NPV, so the project should be done. Here we have a project which provides annual cash flows of 500 for 10 years and costs $2,000 today. And the question is, what is its NPV? Now, we do it for two different required rates of return. The first one is 8% and the second one is 25%. So for the first one, when it's 8%, we will have NPV to be the discounted value of revenues minus costs. Now the revenues are actually an annuity, so you can write out the annuity 500 by the discount rate is 8% into 1 minus 1.08 to the power 10. So that's the value of the annuity minus the initial outlay of 2000. So that should give you the NPV. And that equals 1,355. And this is positive. So this is a good project to do, 1,355. However, if the required rate of return is 25%, then you will be discounting the cash flows at 25%. So then your annuity will have a value 500 divided by 0.25 to 1 minus 1.25 to the power 10 minus 2000. And this actually has a negative value of about $215. So what we see here is that NPV can actually change sign depending on the required rate of return, the rate of discount. So though this project satisfies a required rate of return of 8%, if the required rate of return of 8%, it's a good project to do. The NPV criteria says, however, if your required rate of return is 25%, then this is not a project you should be doing. Finally, we ask the question, what discount rate will give a 0 NPV? So at what rate will you just say, okay, you may do the project, you may not do the project, really doesn't make a difference. A 0 NPV means that, you know, kind of you're indifferent between doing it. It's not a bad thing if you do it, and it's not a bad thing if you don't do it. So for that, what we're going to do is we're going to set NPV to be 0, or we're going to say 0 equal to 500 by R, where R is the rate of discount, 1 plus R to the power 10 minus 2000. You can actually take this 2000 here. So basically the value of this annuity should equal 2000. And you can use your financial calculator to solve for solve for R. You know, in your financial calculator, you put in present value equal to 2000, PMT equal to 500, N, the number of periods, equal to 10, and then you hit compute, and then it should spit out the rate of return. The rate of return actually turns out to be 21.41%. So at 21.41%, the project, you're indifferent. You can do it, you may not do it. You know, nobody can blame you either way. The other kind of interesting thing about this number is that you can alternatively say that this project produces money at a rate of 21.41%, which we shall later tie up with the related concept to NPV, which is called the internal rate of return. So you can either say if the required rate of return is 21.41%, the NPV is 0, or alternatively you could say that this project produces revenues which pay off your initial investment at the rate of 21.41%. In the next NPV example, we have a restaurant which is to be set up, and it requires an initial investment of $60,000. It will produce a net cash flow of $42,000 for first year, and that will grow at 10% forever. If the required rate of return is 16%, should you set up the restaurant? So basically you calculate NPV to answer this question. And you have a cash inflow at the end of the first year of 42,000, and it's a growing perpetuity. So for a growing perpetuity, you are going to take the discount rate of 0.16 and you subtract the rate of growth of 10%. So this is the formula for a growing perpetuity. It is cash flow divided by R minus G. So this is the value of revenues discounted back to today that this restaurant is going to produce. And then NPV will be the value of revenues minus costs, and costs were 600,000. 600K. And that would produce a net NPV of 100K. So it's a positive project, and you should do it if your required rate of return is 16%. The second part of the question asks, what is the rate at which you would have NPV to 0? So you set NPV to 0, and you say that is equal to 42K divided by 0.16 minus G, and this rate that you're looking for is actually the rate of growth. There's a rate of discount and the rate of growth, and we are actually calculating the rate of growth. So we set that equal to the present value of the perpetuity equal to 42K divided by 0.16 minus G, and minus the initial investment of 600 So what this gives us is 16 minus G equals 16% minus G equals 42K by 600K. So that's equal to 7%. So G will equal 16% minus 7%, or G will equal 9%. So if the revenues grow at, or if the net cash inflows grow at 10% forever, you are getting a positive NPV of 100K. If they grow at 9%, your NPV will be 0. Or at 9% growth, you are going to break even in an NPV sense. In this NPV example, we introduce some more features of the real world, and of course one of them is taxes. So you have a leasing business and it can buy 100 computers for $240,000, and it will rent them out at $1,000 each for 3 years, and then these computers will be worthless. The depreciation is straight line, and that has tax implications. The tax rate is 34% and the required rate of return is 10%. So the question is, what is the NPV of this project? So first let's calculate depreciation, and that is going to be equal to the initial investment of $240,000 divided by straight line depreciation over 3 years, or that's going to be $80,000 a year. Now, EBIT is going to be, you look at your revenues, and your revenues are 100 computers at $1,000 a year each. So for each year you have revenues of 100,000, and in the simple case we assume that there are no other costs except the first initial investment that you made. So your EBIT is going to be 100,000 minus depreciation of 80,000, or that is going to be 20,000. Now, if your EBIT is 20,000 and you don't really have any interest payments, so your tax is going to be EBIT into the tax rate. So tax is going to be 20K into 34%. That is equal to 6.8 thousand. And now you can calculate how much net cash this project produces, and the amount of net cash is going to be, or you call it, let's say, operating cash flow, is going to be 100K minus 6.8K, or that's 93.2K. Now note that depreciation is not subtracted. Now depreciation is an expense only for tax purposes. It's not really cash that the firm has to pay out. So the net cash produced by this project is 93.2K every year for a period of 3 years, and that will make NPV equal to 93.2 divided by the rate of discount. We are trying to find this value of this annuity, the present value of this annuity, which is a cash flow of 93.2 thousand every year for 3 years. So 93.2K divided by the discount rate is 10% into 1 minus 1.10 to the power 3. So that's going to be the present value of what the firm, what this project produces, and you have to subtract what it consumed, and what it consumed was 240K. And you work this out, and you're going to get NPV to equal minus 8.23K. So it's a negative NPV, bit of a disappointment, should not be doing this project. Now we come to IRR, internal rate of return, which is a related concept to NPV. And here we ask a somewhat different question, but the logic, underlying logic is still the same. In IRR, we ask, you look at the cash flows a project produces and you estimate the rate of return being generated by these cash flows on your investments. And then if the rate of return exceeds your required rate of return, then you would do the project. In most circumstances, except a few unusual circumstances, NPV and IRR will give you the same answer, whether to do a project or not to do a project. That is because when the rate of return generated by a project exceeds the required rate, it also means, so the rate of return, let's say it's here, and the required rate of return is here, and the IRR, the rate produced by the project is here, and it's higher. It also means that when you reduce the rate of discount, it should increase the value of the revenues which are produced in the future, giving you this, giving you a positive NPV. So IRR and NPV should give you the same answer, except in some unusual circumstances where there could be a lot of investments or a lot of costs in the future rather than in the present, because normally when you think of a project, you think of you have to invest money first and then you get your returns later. But if it's kind of reversed, then IRR and NPV may not give you the same answer. So let's just start out by looking at a simple IRR example. And we go back to the tasty franchise, which was our starting point for NPV. And if you remember, it needed initial investment of 1,100. And then what you're going to do is you're going to set the initial investment required to equal the discounted value of cash flows. So which is like saying the same thing as what rate of return do those cash flows produce on the initial investment. Refer back to my discussion at the very beginning of the time value of money lectures, where I said how rate of return and rate of discount are the same thing. So the cash flow for the first year was 0. So that you discount by for one period. The cash flow for the second period was 500, and that you discount for 2 periods. And the cash flow for the third year was 1,500, and that you discount by 3 years. Now, to find IRR, you can use the trial and error method, or you can use your financial calculator, and this is a case of uneven cash flows. You enter the cash flows, and then you ask it to compute the rate of return. And the rate of return turns out to be 44.5%. So if your required rate of return is less than 24.5%, then you should do this project. If it is more than 24.5%, you should not do this project. if you found the NPV, let's say by saying that the required rate of return was 10%, you would have discounted these by 10%, discounted these three cash flows by 10%, and you would have ended up with a number here which would have been larger than 1100. Because if discounting at 24.5% reduces these values to 1100, then discounting them at 10% will reduce them to a number greater than 1100, and that would give you a positive NPV. So again, if you use NPV or if you use IRR, you would have got equivalent answers, because if your NPV discount rate is less than 24.5%, this value will be greater than this value, and your NPV will be positive. Here we have another example of IRR, and we have these cash flows. The first year it's a negative cash flow, so you can think of it as an investment, and then the project produces these cash flows, and you're asked to calculate the IRR. So one way in which you think about IRR is the rate which makes NPV 0, and so you basically again set it up so what is the NPV? Well, the NPV will be minus 2000, which is the investment, plus 740 by 1 plus IRR, plus 680 by 1 plus IRR square, plus 1120 by 1 plus IRR cube. Now stick these numbers into your financial calculator, and you will see that the rate of return will be 12%. Or you just take my word for it and put in 12% into this formula and see that it will lead to an NPV of 0. Now what we're going to do is we're going to check if this project actually does produce a rate of return of 12%. Okay? Because we are saying that doing this means that this project has an internal rate of return of 12%. So let's look at what rate of return is produced by these cash flows on the initial investment of 2,000. So if the initial investment is 2,000 and you have a 12% rate of return, then your interest for the first year is going to be 2,000 into 12%, or your interest is going to be 240. Now, if your interest is 240 and you pay 740, then your principal reduction would be 740 minus 240. That would be equal to 500. So your remaining principal is going to be 1,500 after this payment has been made. Now on 1,500, the next year, again 12% rate of return, the interest required would be 15 into 12% will be 180, and your payment is 680. So again there's a principal reduction of 500, so your remaining principal will be 1,000. Finally, when you come to the third year, you have this remaining principal of 1,000, and you pay interest at 12%. That's the required rate of return, and that's the rate of return that I'm claiming these cash flows produce. So that will be 120, and your payment was actually 1,120. So principal pay down will be 1120 minus 120, which is 1,000, and 1,000 will pay off this principal, and your remaining principal will be 0. So yes, because the remaining principal is 0, yes, we have verified that these cash flows actually produce a rate of return of 12% on this invested $2,000. The IRR equation is a polynomial, and it can have multiple roots. Sometimes you will find that there will be a very odd solution. For example, you look at these cash flows, you invest 44.1, then next year you get back 175, and then the year after that you again invest 230, and then you get back 100. Now if you actually go and solve these, you will see that both IRR 11.11 and 42.86, both of them solve this IRR equation. You know, the IRR equation is basically going to set the initial investment of 44.1 will equal 175 by 1 plus IRR. Then the second year cash flow is minus, so minus 230 by 1 plus IRR square, plus the third year cash flow is positive, so it will be plus 100 divided by 1 plus IRR cube. So you go find the solutions to this, or just believe me that you stick these numbers into this, you'll see that yes, these numbers work for this equation. Now, why do you get these multiple solutions, and do they really make sense? Well, the thing which is happening is there's this large negative cash flow, and if you say that this IRR is 42.86, what it's doing is that it's saying, okay, if you were to discount this back to the present at a 42.86 rate, then this equation holds. Now, what does discounting it back at 42.86 mean? So 1.42 squared is roughly about, you can say about 2. So you're saying that the present value of this 230 to be invested 2 years from now, the present value is 230 by 2, which is 115. And what you're saying is that you only have to invest 115 today to get the 230 that you need in 2 years' time. And where are you going to find something where 115 invested today is going to give you 230 2 years later? You can't find something like that. So even though algebraically this is a solution, in finance, discounting something at a 42.86% rate, when you are thinking of you need that money to be invested in the future, it doesn't make sense. So where this process goes wrong is basically these high IRRs tell you that you are going to be able to invest money, you are assuming which that you can invest money at these high rates, which is not feasible. And this kind of issue of multiple IRRs occurs when you have these large negative cash flows in the future. And so what should you do when you have this kind of a situation where you have large negative cash flows? Well, one alternative is called MIRR, and that's what we are going to study next. So in modified IRR, or MIRR for short, what you do is you take all future cash flows, both positive and negative, and transfer it to the terminal date of the project at the cost of capital rate for the firm. The cost of capital is a feasible rate for investing money and moving money forward through time, rather than the 42% that we had in the previous example. So what you do is you move all cash flows at future dates to the terminal date at the cost of capital, which is feasible. And then you calculate the rate of return on the initial investment, and that is called the MIRR, or modified IRR. So the idea is that the firm is able to borrow and reinvest money at its cost of capital. So now we are going to use the MIRR idea to find what a reasonable rate of return on the investment is. And we use the same numbers as the previous example where we are getting multiple IRRs. Suppose the cost of capital for the firm is 8%, and we want to calculate what the MIRR is for the project. So first move all future cash flows, that's year 1, 2, and 3, to date 3 for at the cost of capital. So year 1 and 2, and the cash flow at year 3 is already at 3, and we move that all at 8%. So total cash flow at year 3 becomes the cash flow at year 1, which was 175, into 1.08 to the power 2. And then the cash flow at year 2, which was minus 230, you move that forward at 8%. So you multiply that by 1.08. And then the year 3 cash flow was 100. So you have 1.75 into 1.08 square minus 230 into 1.08 plus 100, or you get 55.72 as the net cash flow. Then to calculate the MIRR, we calculate the rate which this 55.72 produces on the initial investment of 44.1. And so for it's 3 years in the future, so it's going to be 1 plus MIRR cube, and that's to the power 3. So this gives you MIRR. When you solve this, 44.1 equal to 55.72 divided by 1 plus MIRR cube. When you solve it, you get MIRR equal to 8.11%. And that's a much more sensible number than the 42% which you had for the case of multiple IRRs. Another criteria for deciding whether to do a project or not is payback period. And payback period is the number of years required to receive the recover the original investment in the project. Now, it is not a decision rule in the sense that it doesn't say yes, do the project or don't do the project. Rather, it kind of gives you an estimate of how long it will take to recover your initial investment. So it's not a decision rule, and the earlier you recover the money, the better. Cash flows after the payback period are ignored, which is not very rational. There's also a version of payback which is discounted payback period, and here you look at in the payback period you're not discounting, but here you discount the cash flows and then you see how long it takes for the project to pay back your investment, and you're comparing the investment to the cash flows produced by the project, but after discounting those cash flows. So that's how you find discounted payback. And again, similar to payback, cash flows after the payback period are ignored, which is not a good thing. Here we have an example of payback and discounted payback. The project requires a $120,000 investment, and it produces these cash flows. So the first question is, what is payback period? Well, you want to add these up, and you want to see at what point you get back your initial 120,000. So you add 40 plus 50, so after 2 years you've got back 90,000. So you have not got back your entire amount, so your payback period must be greater than 2 years. And at the third year, you get 40 plus 50 plus 40, or you have 130,000. So that exceeds the amount invested. So 3 is greater than the payback period, and 2 is less than the payback period. And what is it exactly? Well, you take a fraction of it, which will give you exactly 120. So 3/4 of 40,000 is 30,000. So 30,000 plus 50 plus 40 is 120,000. So you say that this 120,000 investment is paid back after 2 years and then 3/4 of the third year. So your payback period should be equal to 2.75. That's 1, 2, and 3/4. Now, what about discounted payback? Well, you look at the discounted cash flows, and one thing you know right away is that discounted payback will be longer than payback because discounting reduces the value of cash flows. So you look at these discounted cash flows and you add this, this, and this, and what is the total? Well, the total is 111.66. Now, 111.66 is less than 120, so your discounted payback period must be greater than 3 years. Because after 3 years, you only have recovered 111.66. So you still have left to recover 8.34. And the fourth year produces 22.05. So you divide 8.34 by 22.05 to get the fraction of the fourth year that you will need in the discounted payback, and that turns out to be 0.38. So you can, the discounted payback will then be 3, 1, 2, 3 plus 0.38 for the fourth year, or discounted payback is 3.38.